Welcome back. You're still tuned into Midcap Radar. It's time to put spotlight on IT hiring trends in other sectors as well. Teamlease, in a recent report, says hiring in India's IT sector is set to post faster YOY growth in the next 6 months, adds that the first half numbers indicate a robust recovery in IT hiring. To understand this and more, Ramani Dathi, the CFO at Teamlease Services, is joining in now, and we'll try and understand some aspects about the business as well. Ramani, good afternoon. Thank you so much for joining in. Well, first up on what's happening in the IT space, we did get the guidance upgrade coming in from Accenture as well today. So that has actually made the IT space really happy. What are the hiring trends suggesting now? How was it in the first half? And what is the outlook going forward?
Sure. Almost after 5 quarters in a row, this is the first quarter where we have seen at least there is no further drop in the headcount as far as IT services is concerned. Because we are seeing minimal low single digit growth in GCC side, but IT services consistently for last 5 to 6 quarters, they are dropping numbers, especially on the contract staffing side and overall IT employment numbers also. And Q2 is the first quarter, as I mentioned, in a long series of 5-6 quarters, we have seen that the net drop in headcount has finally been frozen. And we are expecting H2 to post at least 8 to 8.5% year-on-year growth compared to H2 of last year. And the skills where we are seeing the maximum demand coming in IT services segment is cybersecurity, cloud, DevOps, project management, AI, ML related. And we expect a much positive momentum going into next year in terms of hiring requirements and overall demand.
Good afternoon, Ramani. Ramani, while you call out saying that there could be close to 8% growth as far as H2 is concerned, one thing that we also have to keep in mind is the fact that it comes off a very low base, right? A base of degrowth. So are we now expecting IT hiring trends to come back to the normalized range, or is it still weak compared to historical averages?
No, definitely it's still weak, because even though we are saying 8.5%, as you rightly pointed out, the base is very low. Like even in our own case, we lost almost 30% of our headcount since we are into contract staffing over the last 6 quarters. And on a lower base, this number may not be very high. But the fact that finally we are seeing a positive momentum and pickup in the hiring trend is a good outcome. And especially for the next financial year, we are very positive that we should get back to a growth rate of 20 and upwards of 20% for FY26.
Okay, so growth rate of 20% in IT hiring from FY26. Ramani, any particular reason why we are seeing this? Is it improved demand? Is it higher spending that has come by? And where are we seeing this higher spending come by? And from which space? Is it the BFSI? Is it other sectors?
No, it's not just 1 or 2 sectors that are driving this kind of demand, because for a long time, many IT services companies have kept hiring on freeze, and many of those have already hit the optimal levels in terms of their employee productivity and optimization. And they have been consistently winning new deals as well. And now that they have already reached the peak utilization, the hirings have started. And BFSI may be one of the initiator, but we are seeing demand coming across all the sectors as well.
Just moving to your financials, when we talk about Q1, there was quite a big hit as far as the EBITDA margins was concerned. Of course, you attributed to quite a lot of one-off factors like seasonality, delayed university billing as far as the EdTech business is concerned. Q2 onwards, can we expect EBITDA margins to bounce back significantly?
So sequentially, for the next 3 quarters, we are very confident on posting a 20% growth QOQ. And this is on absolute profits, not specifically on a margin percentage. Because for us, the margin percentage is dependent on various factors in terms of like which industries are hiring more, where are the average salaries higher or lower in which locations. So going by absolute profit number as a rupee value, we are confident of maintaining a 20% sequential growth for next 3 quarters in this financial year.
Okay. I wanted to understand the sectors which are doing well for you now. The last time we had spoken, you had indicated large NBFCs are still under pressure, but FMCG is seeing a comeback in terms of demand. With the festive season coming in, and we do have rural recovery also come by, what kind of growth rates would you be looking at in these 2 particular sectors?
Yeah. So given the festive season ahead, we are expecting a close to 20% year-on-year growth in FMCG, FMCD, e-commerce and retail segments. These four segments ideally for this quarter would give us the maximum contribution to the overall growth. BFSI continue to be softer because in the past, even BFSI used to give us upwards of 20-25% volume growth, but that has come down to single-digit growth number now. We are expecting recovery maybe after a quarter. We have to see. As of now, we are still, as far as BFSI is concerned, we are still in single-digit growth rate. And we are also seeing good pickup in manufacturing, pharma, telecom, and other industry verticals as well, maintaining close to 20% year-on-year growth.
Ramani, in the Q1 call, you highlighted a couple of things. Number one, you did mention that as far as the general staffing segment is concerned, you're seeing significant tailwinds. How do you see that playing out? And could you give us some numbers in terms of how do you see that particular vertical actually growing on a year-on-year basis or even sequentially? And also last time we did, get you on the channel to speak about the budgetary allocation as well as some fillps given to this sector. So has there been any on-ground improvement from those initiatives?
Yeah. No, firstly, with the internal initiatives that we have taken, the volume growth has improved from a 14% CAGR to close to 20% CAGR now. And this 20% headcount growth we have been consistently maintaining for the last 4 quarters, and we are confident of maintaining that number into future as well. As of now, we haven't fully assessed what would be the impact of any regulatory changes or the government initiatives and budget allocations at this point in time. If those notifications fully come into picture and give us more tailwinds, so the acceleration can go upwards of 20% year-on-year growth.
Okay. And how is EdTech going to contribute from here on? You did indicate margin improvement to come by because of that as well. You have spoken about expecting a steep increase in EdTech profit. How much is it contributing right now? What kind of steep profits that you're talking about here?
Yeah. For us, EdTech business roughly gives about 100 crore in top line, but that's one of our higher margin businesses, giving almost 6 to 8% EBITDA margin. And this year, we are expecting a slight improvement in their margin percentage as well as absolute profit contribution to the bottom line. However, this year, because of UGC guidelines to all universities asking them to realign their curriculum to the new education policy, the billings got delayed, which are supposed to happen in Q1, Q2, got deferred to Q2, Q4. So almost 100% of the profit for our EdTech business will be booked in the second half of the year, but we'll be maintaining at least a 40 to 50% growth in absolute profits of our EdTech business on a year-on-year basis.
Ramani, one thing that the street has been eagerly waiting for is inorganic expansion. We do understand that as far as the HR vertical is concerned, HR tech vertical, you were scouting for possible acquisitions. Any progress on that front? Any possible targets in mind? And what will be the size of these acquisitions and how will you fund it?
Yeah. No, for us, our acquisition strategy is very clear. So we only focus on India businesses. We don't have any plans of expanding outside of India. And we are focused more on the organic growth. Any M&A discussions that we are doing are to give us some capabilities, some entry into a new areas or new modules that we are so far not entered into, or maybe to accelerate the scale. And because of that, the size of the acquisitions, the ticket size would also be typically under 100 crore. Because in the businesses that we are operating in most of the businesses, we are among the top players. So there is no requirement for making any large deals. And we want to focus on organic investments more rather than inorganic. Having said that, in HR services, we are in active discussions with a couple of M&A deals, and these are specifically aligning to our HR tech solutions, which can be cross-sold to our staffing clients, as well as building it as a separate standalone business entity as well.
Okay. All right, Ramani, thank you so much for joining in with those insights. The street seems to like what you're saying. The stock is at the day's high. So some recovery after some lull that we have seen in the IT space, and the other sectors also doing well for Teamlease. We'll do one thing. We'll slip into a short break. Up next, Ashish Mudhani of ICRA will decode opportunities for EPC players in the interlinking river project. Interesting discussion lined up next.